please welcome Nitesh Nath, CEO at DFlow.
Hey everyone, it's good to be here. First, thank you to the Multicoin team for organizing this event, having me here with you today. I'll be speaking about the evolution of market microstructure on Solana. Since the genesis of the network till today, kind of what I think is coming up next. So first, a little bit of a background on myself and DFlow. I am the CEO of DFlow, a company building trading infrastructure on Solana. We connect wallets, retail trading applications, and institutions to high-quality liquidity on the Solana network. This year, we've seen a ton of incredible growth on the business, over 33 billion in spot trading volume, which is small in traditional finance, but big on-chain. And this volume is increasing about 1.2x month over month. Through our integrations, we service over 1 million active retail traders per month. So, okay, before we dive into the history of market microstructure on Solana, it's worth kind of defining the constellation of things that exist and how the network is structured in terms of the liquidity on the network. So, decentralized contracts, which are things like AMMs and order books, are deployed to the Solana network. These contracts house liquidity and are managed by liquidity providers in various ways, including if it's an AMM, very passively, if it's an order book, actively, if it's something new like a high-frequency market maker, extremely actively. So just to actually go back a slide here, these liquidity contracts effectively form a very large price graph. This price graph is the sort of like primary house of like sellers and buyers that have resting liquidity that aggressing retail takers trade with. The predominant way that like network users actually access this liquidity is through an order router like DFlow. What DFlow actually does is find the best price for the user by solving a very large optimization problem on this graph. And the best price in scenarios like this might be achieved by atomically composing the liquidity from these various contracts together into a series of trades. So the DFlow router contract matches buyers and sellers. It is a matching engine. And it's not the same type of matching engine that you would expect to see on the CME, for example, but it is a matching engine and it runs on Solana. Let's look at the microstructure of this matching engine 2.0, a router contract. So the core logic of how a router matches buyers and sellers is by taking an aggressive resting order and an aggressive order from a retail taker and matching it against resting liquidity on the network. For example, the best way to cross the spread in this example trade with Sol involves making multiple smaller trades atomically. In this example, Sol is traded for USDC, USDT, and composed through multiple partial fills like you would expect on the CME, matching against different liquidity providers until the user receives an optimal output amount. So there are a few notable differences between this kind of market microstructure and what you would find on a matching engine sitting inside of the CME. The first, and remember throughout this is all happening atomically. This is a single operation. The first difference here is there's no tick size. So a tick size is a very important facet of market microstructure on exchanges like the CME. Here, there is no tick size, no strictly defined tick size. Liquidity providers like, in this example, SolFi, Orca, Humidify, are able to define their own tick size or choose not to even have a tick size and quote along a continuous curve. Second, because of the absence of predefined tick sizes, there's no queue position. Queue position is also something that high-frequency makers on exchanges like CME think very carefully about. Buyers and sellers are matched in this model by a series of trades that compose across a very diverse price graph and optimize the price that the retail taker pays at the end of the day. Okay, so we've seen that the router is a matching engine. This is an argument that I'm making. It matches buyers and sellers. Let's look at the history of this router microstructure on the network. We can break down the history of this microstructure into 3 distinct phases. In the first phase, which was about until 2024, liquidity providers were agnostic to the router's actual microstructure. In the second phase, which is 2024 to about present, liquidity providers became very aware of the router's microstructure. And in the third phase, which we are now entering, liquidity providers are being opinionated about the router's microstructure. I'll explain what each of these 3 things actually mean. So in the first phase, liquidity providers on the network quoted in ways that were completely agnostic to the router's actual microstructure. For those in the audience with the high-frequency trading background, being unaware of the microstructure that you were quoting on sounds suboptimal, and it is. But this was the state of Solana's microstructure up until about last year, when the router invoked trades on the various contracts that were deployed to it. Those contracts had no logic that assumed a router was making the trade. So what does this actually mean for 2 routers that are competing against each other? For 2 routers that are competing against each other, the routers see the same exact liquidity graph. Because the liquidity provider is agnostic to the router, it does not care. During this period of time, phase 1, router contracts were effectively commodities. They were completely indistinguishable from one another, and there would be like sort of a lack of a liquidity network effect that would accrue to routers, which I am arguing is a matching engine. On matching engines like the Chicago Mercantile Exchange, liquidity creates a very strong network effect. So there was no network effect that was able to accrue because of this. Now, in phase 2, in early 2024, something special began happening on the network. We saw the emergence of a new sort of like class of very high quality liquidity providers like Sol5 ID Ellipsis team. Today we call these liquidity providers prop AMMs. In practice, they're just high frequency market makers that are quoting directly to the chain in sort of a very 0 to 1 moment for the network. These prop AMMs were smarter. They quoted with an off-chain model directly to the on-chain router contract. And they cared about the microstructure of the contract. That is a novel thing that began happening in 2024, prior to which was not happening. Today, high-frequency market makers like prop AMMs define the liquidity backbone of trading majors on the network. What this did for the liquidity graph is the liquidity graph became richer. It became deeper. It offered tighter spreads than on majors than you might even find on Binance, for example. Prices got a lot better for retail users, and market makers competed against one another to tighten the spread for the users. However, still, from the perspective of 2 different routers, the liquidity graph looked exactly the same. The prop AMMs would quote once on-chain, and each router would have the same view of the prop AMM liquidity. Therefore, no single router has historically benefited from liquidity network effects because no such network effects existed. Now, that's changing. In phase 3, which is, I think we're kind of at the start of phase 3, liquidity providers on the network are beginning to get smarter and faster. This is partially due to a lot of changes to the network, stabilization of validator clients, improvements to the validator clients. But this new phenomenon that we're seeing, in fact, is that liquidity providers are no longer just aware of the microstructure of a contract, they're now opinionated about it. And what this opinion actually means is the contract's microstructure can be designed in a way that offers a better ability for a prop AMM to quote. Better ability meaning less risk of getting picked off in general. Specifically, the ability for a contract to specialize its microstructure to liquidity providers generally means that the liquidity providers can optimize their own P&L better. Now, this has a pretty great effect on routers, which is what we are starting to see today, is that the liquidity graphs that two routers have now begun to diverge for the first time. From their perspective, they can offer meaningful differentiation between one another due to the fact that pricing, because of the microstructure of the contract, can change. Routers become market centers with a moat. And this is a little bit of the network effect that I'm referring to here. As the router's microstructure begins to serve the liquidity provider can offer better liquidity, tighter liquidity with greater depth. This improves the execution quality that retail takers actually see when they're trading, and in effect, the contract sees more flow. More flow means more capture of spread for the liquidity providers, and so on. So why is this all important? And what does this actually mean for Solana DeFi? Throughout each phase of this microstructure journey, retail's execution quality has gotten better. Phase 1 to phase 2, retail traded on a tighter spread. Phase 2 to phase 3, retail spread is still tightening. I think we are about to enter an age where execution quality is again about to improve exponentially. Not necessarily on majors, which are already tighter than off-chain equivalents like Binance, at least on spot, but markets that are more tail, such as prediction markets and various other derivatives and more. This is due to several factors, not just changes in contract microstructure, but the primary one, in my opinion, is due to the competition at the router matching engine layer, so the routing layer. Routers are going to begin competing ferociously with each other to begin building these liquidity network effects that allow them to become the next CME. The main beneficiary of this heightened competition is actually going to be retail users of the network. And that value will diffuse to the rest of Solana DeFi. As trading on the network gets cheaper, for retail across all markets, more economic activity will happen on the network. Downstream of that, we are truly about to enter the golden age of Solana DeFi. Thank you.